Welcome back to the Behind the Wells Show. I'm Roger Abel here with Elias Randall in studio again. Eli, what is new this week? Anything happen in your world?
Nothing new.
Did you have a good lunch?
Wonderful lunch today. Very good lunch. Had some what was it called? Carnita taco salad.
Yeah, that was
pretty nice.
Good. Yeah, they do a nice job out there. Well, let's get into it. You know, we've got a lot of things going to change this year in the markets, and I think one of the big changes coming down the pipe is we're going to have a new Fed chair coming in at some point, and Nationwide just put out a nice little fact chart about what happens 6 months after there is a change in the Fed. And if we look back over time, and more importantly, when it's down, okay, it's not all the time, but when it's been down, the last 5 times, when Paul Volcker came in 1979, the market went down 4%. That was the drawdown between when they took office and 6 months later. Greenspan came in 87. That was a 33% drawdown. Bernanke was 5% down in 06. Yellen was flat, wasn't drawn down. And Powell was down 3% in 18. And I look at this, and it shows me over history, the average drawdown from the time we get a new Fed chair till 6 months later is about 9%, which I look at this chart and I just think, well, the average drawdown throughout any given year is about 13. So is this actually really meaningful information, or is it more just a marketing campaign put out to give someone a talking point? I think this change in the Fed is different, and they probably say that every time. But I think this is a pretty contentious one because they believe that President Trump is putting somebody in there to artificially lower interest rates. And based upon the last Fed meeting, that's going to be challenging to do. There's actually several Fed officials who brought up the idea of a rate increase. And whether that makes sense or not, I don't know. I mean, inflation's under control. We had the lowest CPI since 2002. But I think last month's job surprise has started to get people a little bit concerned about what could happen.
Even if we were to have the average 9% drawdown, that's not really, in my opinion, anything to get too excited about. I mean, less than a 10% drawdown, that's not even...
It's kind of a non-event.
For your money invested in the stock market, it should be.
Well, think about
if a 9% drawdown is causing you to question the way you invest as an investor, that's not good.
You need
that
to
should be
reassess.
Expected.
You definitely need to reassess. You know, if you already think about it, there's sectors of the market this year that are down 8-9% already. If you own software stocks, you're down more than that. Some of those are down 20 and 30. So at the end of the day, I saw this chart. I thought it was good to talk about, mostly because we know there's going to be a change. And I think a lot of people believe it's going to depend upon what political side you're on, unfortunately, is probably skewing your view of what the market's going to be like.
Depending on political outlook or politics?
Well, it's been this way. I mean, unfortunately, the last 5 years is how it's been. Your view of the market is exactly correlated to your political affiliation. I had someone in here the other day. I think the market's going to do really good the next couple of years. But in 2021, he went to all cash because he thought it was going to do really bad. Now he thinks it's going to do really good.
How many times do you think we can share with people, or even they can go read articles from the largest institutions, that the market really doesn't care who the president is?
It doesn't matter because people care. People care. So
What
then,
causes people to care so strongly about
I don't
that?
know.
Is it just because it's every day and it's in our face all the time? And
I definitely believe what's different is what you just said. It's in your face every day because everybody has the 2 or 3 people on their social media feed who are loud, whether it's conservative or liberal, who are loud.
what is loud on social media? It means type a lot. Is that loud?
They post 27.
I get what
They
you're
post 27 times a day. You're not changing someone's opinion if you're loud. But what's different is 20 years ago, if you and I went out together, Elias, and we had dinner, I'd have no idea what your political affiliation is. And frankly, neither would I care. Today, I know vast majority of the people I am around what their political affiliation is, especially if they're loud on social media.
So that was one of my New Year's resolutions for 2026 is I don't talk politics in social settings anymore.
I've tried to avoid it for the better part of 20 years. And here's what I've realized. I'm not going to change anybody's mind, and they're not going to change mine.
Oh, but
No. No, you won't. Your political affiliation becomes about the principles that you want to live your life by. Whether good or bad, it's just what it is. And I think your point of it's in everybody's face, political affiliation should not have any bearing on your investment strategy. Because honestly, the stock market doesn't care who the president is. The stock market cares about monetary policy. The stock market does care about what the Fed chair does because the Fed chair controls monetary policy. But most of those decisions are controlled by what's happening in the world, whether there's inflation, whether we have high or low unemployment, all these other factors. It's not controlled by who the president is. As much as President Trump wants to control the Fed, it's not going to happen. The Fed is not going to lower interest rates if inflation's 5%. They're not going to do it.
they can't.
As bad as he wants to.
Yeah.
They're not going to do it.
They can't, and they do have to. One, they have to stay out of the politics, and 2, they have to make data dependent. That's what they talk about all the time, right? The Fed is data dependent. So if inflation does start to tick up, you can't just then go lower interest rates. And I can understand why people, if all of a sudden we just took rates to 0, I can understand why people would be worried about inflation coming back. There's a lot of pent up demand for different, well, specifically in real estate and then in other markets. So here's what I like about this snippet we found. It says early 2026 indicators look encouraging, but a change in Fed leadership could challenge the market's momentum. Yeah, I agree with that. Could challenge the market's momentum. I think there's a lot of people that believe the market will be higher at the end of 2026 than at the beginning. That doesn't mean there won't be challenging moments throughout the year. That also, just because there's challenging moments doesn't mean that the publicly traded companies in America aren't making money and increasing their earnings and doing all the things they're supposed to do.
I agree with all those points. I think what's interesting is, I don't hear talk of recession anymore. I think that's interesting because 3 years ago it was all the talk. Well, so what happened to the recession? 90% probability of recession. What happened? Did we have one?
I think we just got through it. I think we got through it.
But we didn't call it
relatively unscathed. I think it was an easy one to get through. I don't know how many people, just if you could go to the grocery store and ask people, do you believe, random person, do you believe the economy has slowed down in the last 2 to 3 years? I think most people would say yes. I don't think anyone out there thinks the economy's been going harder than it was, certainly prior to COVID.
It's more challenging for people for sure.
Yeah.
I mean, it's challenging for people to buy a house. It's challenging for someone to buy a new car.
If there wasn't a shortage of labor, I'm sure there would be more layoffs. Companies can't really afford to lay people off. There's no one, they're already short.
But that's already changing too. There was a period of time, do you remember, we called it what was that phase called, where people would leave and go to a new place? You're going to get,
Rehirement?
I don't know if it was retirement.
No, that's not retirement. It was the great exit or something.
Where everybody would just leave a job for $10,000 more. Those days are over.
It did not last very long.
That lasted like a year and a half. But I know people right now that I see on my LinkedIn, they've been looking for jobs for 6 months. The labor market's not that strong.
Maybe we're in a recession.
Well, maybe not. People still buy things. I think here's the thing.
Regardless, though, I mean, recession, the in general definition is economic slowdown. Like there's
for
specific
2 consecutive
metrics.
quarters.
Yeah, there's specific metrics you can assign to it. So maybe it's just a slowdown. Maybe it's not a recession.
Here's the thing. Would be interesting to actually dig into. I think the biggest thing about our current economy is people with assets have vastly benefited in this economy the last 5 years. If you don't have any assets, you've got your butt kicked. Like,
I think what's happened the last 5 years should prove to people that once you accumulate assets, you're sitting pretty good.
They compound.
Regardless of economic or situation.
That's actually a really good point.
Pretty good.
If you just accumulate assets that don't go down in value, a car's not an asset, that's a liability. Assets that will continue to appreciate in value. Who the president is, who the Fed chair is, all these different things, it really doesn't matter. You can tune out most of this noise. Maybe that should be the 2026, just focus on increasing assets. We've talked about it when you buy stocks. Don't focus on the value or mutual funds or whatever. Focus on how many units you own. If you're buying more acres of land every day, you're going to be better off in the future. And really, to do good at that, that's the slow and steady race. In today's society, nobody wants slow and steady, but it is what works. Everybody today wants instant gratification, an instant win. You can even look to things like the young population. They love sports betting. They love it. What happened during COVID? They went to the stock market for their sports betting. Are they still doing that? I don't know. I don't
think so. I think sports betting is just back on.
I think it's all back to sports betting. But guess why they like sports betting?
Instant gratification.
Instant gratification. I know if I won or I lost, and it's addictive and it gives someone, the ability to be engaged in the event. I had a call with a new customer on Tuesday morning. And this individual, they've accumulated a really nice portfolio of agricultural land. And he's like, I'll just keep buying land because I know it's not going down. I trust it. I think that's a great investment. He goes, but man, the stock market scares me to death. It's just like gambling. So got this individual with a $2.5 million net worth of just in land. Half of it's paid for, the 37. So they're doing good on paper, right? I said, well, let me ask you a question. Are you ever going to sell that? He goes, no, I'll never sell my land. I said, so then it's not a retirement asset. So I did a financial plan. I showed them which they still have like 300,000 already saved. So they're not like behind, but they're not like massively ahead, but it's all in cash because they're scared of the stock market. So laid everything out.
What causes them to be scared of the stock market?
Just thinks it's gambling. That's what he thinks. So I laid out, put in the parameters, what you want to live on, all those different things. 100% cash, their probability of success, you could guess what it is when you're 37 and you're never going to be invested in the market. What's the probability? It's zero. Literally just changing their investment portfolio from cash to 100% equity got them to 16%. 60% probability of success. And then his goal was to max out 2 Roth IRAs, put another 15,000. Oh, guess what? They're at 87%. So he goes, let me get this straight. We have to invest the money we have in the stock market, so be all equity, and put in 15,000. We have an 87% probability that our retirement works out at age 65 and 58, two different respectively, and I don't have to sell my land. I said, yeah. He goes, sounds good. Let's do it. But if I would have told him all the reasons that the stock market wasn't gambling, he never would have done it. He wouldn't have believed it because I didn't give him any empirical evidence as to why he needed to be invested into the stock market. But now he has some conviction that when the market gets crazy, I'll be like, well, great. You can have a 0 probability or you can have X. What would you like? And it becomes an easy decision
You're
tree.
still socking away your $15,000 a year.
Yeah.
So it really doesn't matter.
Doesn't matter. But I think that many people see the stock market as gambling, and it's not. It's exactly inverse. We've said this for a long time. You win in the stock market by being invested for a long period of time.
That's one of the key.
You win at
Go
sports betting by winning right away and cashing out. If you keep doing sports betting.
Yeah, that's the key difference. In the market, the longer you sit at the table, the better you're going to do.
I know people that do tons of sports betting and they're good at it. And I'm not talking like $5,000 a year, like a few $100,000 a year, $300,000-$400,000 a year. They're betting.
Fairly expensive hobby.
And I said, what's the range of outcomes here? Right. And like it's anywhere from down 15,000 to maybe up 20 or 30. But most of the time, I'm guessing they're down. They don't want to tell me that.
No. They win.
But it is their form of entertainment. So it's no different than someone else spending $30,000 a year on vacations. You don't spend $30,000 on vacations.
Okay, right. But
and they get some good benefits.
But here's how crazy this is. So someone's willing to run $300,000 through their gambling account it's my hobby. And at the end of it, I make plus 30,000. Go invest 300,000.
Well, no, they don't have. Remember, those are the bets they make throughout the year, so they couldn't come up with 300, right? They're betting.
How much are they actually running through the account?
300,000-400,000
I think
a year
in total bets.
In
I'm
total
just saying.
bets.
I think if you were to compare apples to apples, like the long-term outcome of money you have versus money you put in over a 30-year period, you're vastly better off just being an investor.
For
now,
sure.
that doesn't provide the excitement. It doesn't provide the hobby and all that. But to be willing to put that kind of risk on money, you should be willing to.
Dude, don't get me
invest.
wrong. They're not winning. They can tell me how much they think they're winning. They're not winning. The casino's not in business to lose.
Right, and the casino's whole business model is to keep people at the table for as long as possible.
Yeah, the year they won 30 grand, how do you know they didn't lose 15 5 years in a row?
Well, no one knows that.
Right.
And no one
no one
keeps track
tells
of
you
it.
that.
No
No
one-
one says I lost 50 grand last year. Who's going to admit that?
No.
If I told you, hey, Elias, I'm a big gambler. I lost 50 last year. You'd be like, you suck at gambling. Why are you doing that? You're not going to tell me without you being, oh yeah, I won 30. Really?
I don't know because I don't sports gamble, so I really don't. One, I don't know the draw of it. I'm sure it's a rush, and I'm sure it's exciting. I personally, I'm not a gambler anyway. Cash. I guess I'll play cards. I'll play cards for cash, like at deer camp and stuff like that. But to bet on sports, especially pro sports, that always seems, because I have friends that do it, right? And they'll be like, oh, I put on this bet.
This parlay.
And they're so sure that it's going to happen. And I'm always thinking, you're so sure that the best ball players in the world, that outcome's going to happen. How can you be so sure that it's not high school sports? They're pros. Anyone can win. Well, don't you think it's kind of crazy?
I don't think you can beat the casino. That's all I know. I don't do sports betting. I'm not into it. I've tried. I'm just like occasionally I'm like, oh yeah, I got to do that. And then one time I don't do it again.
Yeah, you're
I
not
play
gonna
fantasy
do this.
football. I don't play for the money. I play to see if I can beat people. I don't care what the money is. I just want to beat people.
In fantasy.
Yeah. I don't care what the win is. I just want the bragging rights. I won.
Did you win the?
I did win
fantasy
this
football?
year. Yeah.
I thought Ron did.
Oh, for the office. That doesn't count. Mark messed up the scoring. Ask Molly all about that.
But you won the league that you play in.
My primary league, yeah.
What do you get for winning that?
700 maybe? Like that?
Does a loser have to do anything goofy?
No, but they did have one where the loser had to sing the national anthem or do something in one of them. That was pretty funny. That was a different league I was in. One of the things that I think as people start to address retirement, one of their biggest fears is how am I actually going to spend this money? Like, I'm fearful of what I'm going to do. So I thought we'd talk about some strategies that can help people overcome a couple of the fears I have in retirement, which is, market downturn, spending too much, running out of money, all those different things. And there's really 8 key factors that somebody should think about when they're starting to put together a retirement strategy. And we've talked about this in depth before, in that if you're going into retirement and you don't know what your baseline spending is or have some idea of what your budget is, most of the time, unless you've just accumulated a really massive sum of money, most of the time you are setting yourself up for extreme disaster and risk if you have no idea what you're going to spend.
And you can overspend. Overspending is absolutely possible. People do it.
Happens a lot. I mean, we have people that don't think they're going to overspend, and then they do. Because you know what happens? They have 1.5 million and they're like, well, market's been great. We'll just take it out. In fact, I had customers who were doing this. Market's up. We're going to take out whatever the gains are. Okay, so you never spent $200,000 a year before, but you did this year and you're retired. And it's worked out because the market was up. But what are you going to do when the market's not up?
Was there stuff to spend the money on?
They found stuff. But that's what happens when you can get your hands on that big pot of money. And that's the risk that people run when they don't do a budget. Because you've lived your whole life off my paycheck every other week, right? For the most part, unless you're in commission or have a business. But then you go to this world where I don't have a paycheck every other week unless you structure it properly. I just have a big pot of money. I'll spend it when I need it. It's very easy to overspend when you don't have a budget and a regular paycheck coming in, which is part of the reason when people retire, we try to get them to the point that they are taking out a monthly paycheck to match what they had before versus just taking money when I need it. Because you always find ways to spend the money.
So what was your message to the clients? Just they were taking out the gains just because? They were taking out the gains for things to buy that they wanted to do. I said, that's actually not a horrible strategy, but I said, clearly you guys have a disconnect between what you need each month and what you're receiving. I've been retired for like a year. I said, how about we send you another $2,000 a month to get you where you need to be instead of you guys just deciding when you need to make a big purchase. And they were shocked because I basically told them to spend more money this year. But it's a little bit reverse psychology. I'm like, I'm going to send you more. We also need to know how to manage it. Is the problem.
Exactly. So they're going to get what they had before. And I said, you guys just need to figure out how to live on this instead of just going to the piggy bank for big amounts of money. I said, do you really want to have your retirement strategy all around when the market's up? That's what she told me, checks every day. If the market's up, then they can take money out. If the market's down, they can't. I said, well, what are you going to do when the market goes down 20%? She's not going to take money out? She goes, well, I don't know. I said, that's why you need to do it how we told you to do this. They're trying to circumvent the bucket strategy into something they think is better. So we got them back on track. That actually goes into number 2. Make adjustments as needed. This is where most people would believe that's a good strategy. They haven't thought about the bad times. So you might need to make adjustments to your spending as needed. 3, super important, and I'll let you elaborate on this. Understand that spending naturally declines over time.
Spending throughout retirement, simply stated, it does naturally decline. And here's the reason. You get older. One, you don't have the energy, you don't have the physical health to do the things you want to do anymore. You've done a lot of them. And I know a lot of people that are in their 80s, and I'm sure people listening know plenty of people in their 80s, been retired for 15 or 20 years. What do they, like, at a certain age, what do you do anymore? What are you spending your money on? What are you spending your time doing? Now, it will decline until then it doesn't. Now we're getting down the road further, but eventually you will have a fairly expensive part of your life when you start needing care, if that ever does happen. But in general, spending naturally declining is a good thing to understand going into retirement, because I think it highlights, okay, the clients you're talking about, they're spending and enjoying, right?
Yes.
The only thing that probably needed to change is we need to be more, this needs to just be more structured how we're going to do this. Where right now we're kind of guessing and we're just, market's up, we'll take some money out. You should spend and enjoy within reason. And the reason you should do that is because over time you will become too old to do the things you want to do and spend time doing.
Here's another kind of take on that too. There's people listening right now that are saying, well, I'm spending exactly the same as I was spending when I retired 5 years ago. Fair. You are spending the same amount. But guess what? Inflation has eaten into that. So inherently you're spending less. The only way somebody's spending the same amount as they were 5 years ago is if they inflation adjusted their spending every year for the last 5 years, which would probably put them at close to 30% more. I can't think of any customer in this office that has increased their spending 30% the last 5 years.
No, that's hard to do.
So that's why you're going to spend less, or your spending declines. You might have the same amount of money coming to your bank account, but if you have for 5 years, you're actually spending less. Number 4, super important. You need to have a recession buffer. This is what we do for people taking money out. It goes back to the conversation with the clients who are taking gains. That's a great strategy in an up market. What's the strategy when it's down? And that's why we like to have that 1 to 3 years of cash sitting in the liquid bucket to lean on if there's a recession, which is exactly what we had to talk about. We need to have a better way to plan for the bad times. I get the last 3 years have been wonderful. That doesn't mean and they retired in the fall of 2022. So since they've been retired, they've had amazing gains. I said, we have to plan for when it's not up 20%, because that's all they've seen since they retired. That was 4. 5, make sure you eliminate any tax surprises. There are people that haven't planned for how taxes are going to work. And I think we see this more as people get to that age, 73, 74, 75, and are taking required distributions on really large accounts. Sometimes there's tax surprises associated with that, especially if you haven't kind of diversified your money between Roth and traditional and non-retirement assets.
Yeah, if you have I think people that run into this, they have all their money in pre-tax accounts, so IRAs, traditional IRAs. They're frugal, so they only, they don't take money out, living on Social Security, and then they turn required withdrawal age. That's a tax surprise, especially if you've done a good job saving and accumulating. Well, now you have to take this money out. And I think the first year, so people turning 73 this year, it's like 3.6 something % of your end of the year value. That can be a pretty large amount.
100%.
Especially in your mid 70s and you haven't taken money out, haven't done any tax planning.
Well, think about this. That's a super valid point people hadn't thought about. Before, up until 5 years ago, RMD age was 70 and a half. Most people had been retired 2 to 5 years and they had to start taking their RMD at 70 and a half. Now it's another 5 years. So if I use the rule of 72 and the stock market averages 10% a year, which it has historically, that means our money's doubling every 7.2 years. So you're 67, you're retired. You don't touch this money for 7.2 years. And let's say you're retired with a portfolio of 2.5 million, which good, pretty reasonable. You have $5 million in an IRA now, 7.5 years later. Yeah. Well, the RMD alone is 160,000. Throw in your Social Security. You have all kinds of things that changed. You're in the 22 to 24% tax bracket. You now are going to have to likely pay the IRMA tax, which increases the premiums on your Medicare, your Part D. All these different things happen because you didn't think about it at 67. I'm having this conversation with a lot of people who are in this situation, same age. Hey, let's figure out how, if you're not maxing out a tax bracket, how do we convert to a Roth, take some of this money out so that you don't have all these unintended consequences earlier? Because here's what happens. People are 64 and they don't want to pay the IRMA tax. Like, well, I don't want my Medicare to go up $80 a month, whatever it is. I said, well, yeah, but if you avoid it now, you might not avoid it in 10 years. What do you mean? Well, here's your IRA. You don't want to touch it because you don't want to pay anything more today. Well, you're going to double the value. So then you're going to be stuck there for the rest of your life. And they never thought about it.
The taxes are coming.
Taxes are coming. If you
sooner or later.
If you have all pre-tax retirement, somebody is paying the tax. You got to figure out who's going to pay it. Number 6, try to anchor with some reliable income sources. So how we do it at Premier is we build a Premier bucket strategy. We do not want income to be random. We want to have a strategy for how we're going to get you dependable income, regardless of if the market's up or down. And that doesn't structure around any one product. A lot of people like to throw this income conversation into a product. We want to have cash on the sideline or cash alternatives to create predictable income instead of some product with high fees that says, oh yeah, we'll give you X amount of guarantee withdrawal every year. We want to do it through a bucket strategy approach that keeps your money accessible when you need it.
The other thing to keep in mind, your income, the strategy does not need to be overly rigid. And that's always a good conversation, I think, with people first retire, is letting them know we're not making the decision of how we're doing this for the next 10 to 15 years, like the way we set out to do it today. Mm-hmm. We can be flexible in this, but we do need a starting place. And I think this tip here, let's at least get your baseline month-to-month life in order from an income perspective and go from there. That doesn't mean, hey, I take out $2,000 a month and then that's what I'm going to do forever. You could take less, you could take more, but you do need to have a good starting place.
That's why
you can make and I think that was one of other tips, make adjustments.
And that's why we do a plan. A lot of people tell me they need $8,000 a month, but I'll give them what the upper parameter is. Like, hey, if you go outside of 8,000, this is the max you should spend every year for the rest of your life. It might be 13. They're like, well, I'm not going to spend that. I said, I get that, but that's your permission when you want to go do a vacation. I'm making you feel okay about it. There is some buffer here if they have it.
It's good to know.
Yeah. Number 7, I think this is really important. Think of the income you can generate or take off your portfolio as another way to fund long-term care. So many people want to go buy an insurance policy that pays for all of their long-term care. Remember, if you need assisted living, in-home health care, or long-term care, your Social Security doesn't go away. Your pension doesn't go away. The income from your portfolio doesn't go away. Sit down and figure out what your real risk is here before you go spend a lot of money on an insurance policy. And I'm not saying it's not valid to have those. We have a lot of people who have long-term care insurance and they're happy that they do. But let's just not go buy it because someone said we have to buy long-term care insurance until we know what we really need to have. And number 8, we're going to end it with this. Don't use your home equity as a backstop. A lot of people see equity in their home as an asset. It's not an asset. Your home is 100% a lifestyle and a place that you're going to live. Once you start viewing your house as a retirement asset, that is how people get into big trouble. I can think of multiple things: reverse mortgages, using home equity lines of credit. Well, if you run up debt when you're retired, how are you going to pay it off? You clearly didn't have the money to purchase what you wanted to buy. How are you going to pay the debt off if you couldn't afford the purchase? People just don't think about it.
I don't like the idea of using using home equity as a backstop or kind of like a safety net. I think there's better ways to do that.
Yeah. Well, with that said, I want to thank everybody for listening to today's show. If you have any questions about how to build an income strategy or get a financial plan that kind of shows you where you are today, where you're going in the future, go to btwellshow.com or click the link in the description. We'd be happy to get you in contact with one of our advisors to sit down and have a complimentary consultation. Elias, do you have anything you want to close the show with?
Thank you for listening. Appreciate it.
Thanks.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.